Well, good afternoon. Hi, I'm Ric Edelman, the founder of the Digital Assets Council of Financial Professionals, DACFP. Thanks for joining us for this event. I'm really excited about it because it's one of the hottest topics in the world of crypto and one of tremendous interest of financial advisors as well as investors in crypto, because this is about as fundamental as it gets. And it really speaks to the practical element of this conversation, which is befuddling many, let's face it. So I'm really glad that we're talking about this whole notion of crypto and self-custody. And to help us guide through this conversation, let me bring on Miguel Kudry. He is the CEO and co-founder of L1. Miguel, why don't you join us? How are you?
Hi, Rick. Good to see you. I'm good. How are you doing?
Doing very well. I'm glad you're joining us for this. I was really interested in putting this topic together. I'm really glad that Miguel agreed to come on the program with us because this is a really fundamental conversation. And I want to set the stage for everybody as we delve into this conversation with Miguel. Before I do that, though, Miguel, why don't you tell everybody about L1? Because I think that not everybody is as familiar. I mean, Miguel, you yourself have been in this space for 7 years. You've got a long history in this, both in North America and Latin America. You co-founded Ben.co, and you've been involved in the development of consumer products and, with tens of millions of people over the years. But tell us what your latest venture is and your work with L1.
Yeah, thank you, Rick, for the intro. So at L1, we're building a platform for financial advisors to work with their clients who are holding digital assets in self-custody. So that means that as an advisor, you can actually connect to your client's assets, basically get read-only access to them. It is completely non-custodial and non-discretionary, yet you get the ability to look at their portfolios, look at their positions, both in wallet and with assets locked in any protocols, as well as you can make transaction recommendations directly on DeFi protocols. So this is completely non-custodial and non-discretionary, and we are the interface between the two.
And it's really important to make that that distinction for the fundamental reason that, and I've run into this all the time, I'll bet Miguel you do too, where advisors, I ask them the question, do you have any clients who own crypto? And so often I have advisors who say to me, no. I'm like, you're kidding yourself. 22% of US adults own crypto. And to suggest that the wealthiest of Americans, the people who are typically clients of advisors, to believe that none of your clients own crypto when 22% of US adults do is just head in the sand mentality. In fact, in one survey by CNBC, 80% of millennial millionaires, we're talking millionaires in their 30s and 40s, 80% of them say they own crypto. And that means you've got clients who own crypto. It's as simple as that. And yet we know the diciness of this conversation. Advisors are struggling to figure out, how can I effectively engage in this asset class? How do I do this in a manner that is compliant, that allows me to, on the one hand, serve my client and their needs, but on the other hand, not run afoul of the regulations? How do I do both? How do I serve clients while maintaining regulatory compliance? And the reason it's such an issue is that we know that because most advisors don't think their clients own crypto, and let's face it, by extension, Miguel, most advisors are not talking to their clients about crypto. They're not recommending crypto. They haven't helped their client obtain their crypto. This means the clients are doing it all on their own. And if they're doing it on their own, that means they're doing self-custody. And let's face it, clients are their own worst enemy, right? That's why they hire advisors in the first place. They need help with all the broad issues of investment management. And if they're suddenly going to be engaging in self-custody of their own crypto, do they really know what they're doing? Do they understand the risks that they're taking? Advisors not engaging with them means the clients are setting themselves up for failure, for fraud or abuse, or if nothing else, excessive fees or other concerns. This is why I'm convinced that advisors need to learn about custody for crypto so that you can do a better job at serving your client, giving them the guidance that you provide them in every other asset class. And so that's the foundation of today's conversation that I really want us to talking about today with you, Miguel. And we're going to invite questions from you as well, who are watching and listening to this. So in the Q&A button at the bottom of your screen, you will find the opportunity for you to submit your questions. Many of you submitted questions in advance when you registered. I'm going to be interweaving the questions you've asked along with the questions I have for Miguel throughout this conversation. So feel free to share them in the Q&A box. The first thing that I want to ask you about, Miguel, it's a reference to the comment that I made earlier. 80% of millennial millionaires own crypto. You tell me why. I mean, you're a millennial. Why do so many millennials own so much crypto?
Yeah, well, great intro. And millennials love crypto. That is a fact. And when you think about it, we are the generation that grew up online. We were raised online. We've seen the internet become part of our day-to-day lives. We socialize online, we work online, we make friends online. And so when everything in our lives happens online, we expect our money to be online as well. So for us, we very much see crypto as the internet of money. And so I think that's going to have a huge impact on our business, on the business of money. And so any financial advisor that is not at least figuring out whether their clients are basically whether they own crypto, whether they're thinking about crypto, is not doing themselves a favor. And we're also long past the conversation of crypto as an asset class. This is all about crypto as a platform of asset classes. So yeah, the future of money and assets is crypto.
You know, it's really interesting. T. Rowe Price did a study last year of teenagers. They asked them, if we gave you $100 to invest, where would you invest it? 57% said they'd buy crypto. Only 38% said they'd buy stocks. Clearly, the younger generations are more and more likely to believe that crypto is real, that it's dominant, that it's an important investment for their future. And so let's invert that. We've got the wealth transfer coming up. You know, the baby boomers are aging out. The greatest generation, ahead of them are dying out. We've got, from everybody who talks about it, projecting $70 trillion over the next 2 decades are going to transfer from the elders to the next generations, which means those millennials, along with every other millennial, as well as the Gen X, Gen Y, Gen Z who are following them, are about to inherit unprecedented amounts of money. So, and I have to assume if these folks like crypto and they suddenly get an inheritance, they're going to be buying more crypto. So this whole asset class is only going to grow, I would assume, from that basis over the next couple of decades. All that argues.
I mean, not only will they buy more crypto, Rick, well, they will actually push institutions in the direction of tokenizing real world assets. We're talking about tokenizing real estate, tokenizing security. We want our assets to be online. And the traditional rails that power assets today, or non-crypto assets today, just aren't efficient enough. And so that's where this massive generational shift from baby boomers to millennials and our parents is kind of adding fuel to the fire, where you have a new platform shift, a new technology that makes this actually possible. The two come together and big change occurs. So anybody in this business should be paying close attention.
Yeah, and this isn't something that's coming in 10 or 20 years. It's already here. Franklin Templeton has already launched a money market fund on the blockchain. You don't buy shares of the fund, you buy tokens of the fund. They call them Benjis, and you use an online app. You don't even open a brokerage account. Now, if one of the biggest asset managers in the world is already doing this, you know that all of them can't be far behind. So you're exactly right. I mean, we want to be able to have digital ownership of our assets the way we have digital ownership of our photographs.
Exactly.
So all of this argues for more advisor engagement, right? I mean, I don't see any way around it.
Yeah, the reality is most advisors report, I think the number is 59%, report having clients investing in crypto outside of their advisor relationship. And so anybody that says that their clients are in crypto just isn't talking to their clients. So I think now is the time as an advisor to really dive in and understand the impact that crypto is going to have in your business, that self-custody is also going to have in your business. I mean, lots to talk about on the regulatory side and on how self-custody is actually changing the landscape. But as an advisor, now's the time to prepare and really understand how you can actually build a generational firm on this new platform that crypto represents.
Well, we are in the midst of, I have to call it a dicey time. That's a technical term, a dicey time for the world of crypto. I mean, we're still emerging, everybody licking their wounds over 2022. We saw the failure of centralized lenders, exchanges, and custodians. We saw huge losses in crypto among retail and institutional investors. We saw the erosion of trust as a result of the debacles like FTX. We have new SEC opposition to crypto that really wasn't as prominent as it is lately. But all of that going on, we also have under the radar something else going on right now. Talk about the DeFi protocols in the midst of all of this. In fact, start by talking, make sure everybody's familiar with the difference between a DeFi and a CeFi protocol, and then explain the differences.
That's a great question. Yeah, so I think a very easy way to put it is these are databases. So DeFi, decentralized finance, and CeFi, which stands for centralized finance. What we're really talking about here is public databases and private databases. And then there's infrastructure that is both public and private on either side. Decentralized finance is a set of different protocols and applications that run on a public ledger, and that anybody, you and I, can basically go and see what's going on at any time. There's 100% transparency. We can both participate as people transacting on the network. We can both participate as builders. We can build a financial protocol or an application that communicates with a protocol, and we can bring a financial product and service out to the market. And anybody basically has full transparency on what's going on. It's 100% public. CeFi, on the other hand, is very much like a black box. I mean, FTX was CeFi. It is a private database. It is private infrastructure where you, as a customer, deposit some funds and you trust that somebody is going to actually give you your funds back when you want to make a withdrawal. And so you don't really know what's happening once your deposit is made. So that leads, in the worst of circumstances, to an implosion, to basically the exchange or a centralized player blowing up, like it happened with FTX. And so guess who was the very first creditor that got paid as FTX was going down?
I have no idea.
DeFi protocols. It was the lending protocols where Alameda Research and people at FTX had loans. They were actually unwinding those positions, and all of crypto Twitter was actually commenting as that was happening in real time. Those were the very first positions that were paid, and the reality is, if they didn't get paid, they were going to be liquidated. So that's just a crazy precedent when a DeFi protocol is first in line because nobody else can basically get in the way and say otherwise. People start to take notice. So yeah, DeFi protocols were the very first to get paid.
And what's the takeaway there for Miguel of this? Is this suggesting that if you're going to engage in crypto, you should be using a DeFi platform as opposed to CeFi?
I think there's pros and cons on both sides, especially as user experience continues to improve. So we are making it our mission to help people use DeFi as easy as possible. Make basically access to DeFi very easy through the use of an interface that allows them to work with somebody that they trust. and kind of abstracting a lot of complexity away. I think on the centralized side of things, there are benefits in terms of being a great on-ramp into crypto. If you're new to crypto and you want to dive in, you're going to want to use an exchange most likely to get your foot in the door. And then I think that's the time where you need to start looking into self-custody, because it is true what they say: not your keys, not your coins. As soon as you go into self-custody, you can basically start using DeFi protocols. And so that's what we make really, really easy for both clients and advisors. There will be products and services offered by centralized players. Many of them are basically white labeling what is offered in a decentralized way, and they're kind of putting a fee on top. I wouldn't recommend those. I think as a self-custodied individual that can basically tap into world-class financial products and services within DeFi, you get to keep more of your money in your pockets, right? By being in self-custody. I would look at CeFi as the on-ramp into crypto.
So in that example, you're suggesting something like a person opening a Coinbase account or Gemini or Kraken, where
that's right.
It's this is a crypto exchange similar to a stock exchange. Instead of going to Merrill Lynch to buy stocks, you go to Coinbase to buy Bitcoin, and that's a CeFi platform. You use the phrase, and it's a common one. I want to make sure everybody understands its meaning. Not your
keys, not your coins.
Not your keys, not your coins. So when you refer to keys, you're referring to the password.
To the private keys, correct.
There are two passwords. There's the public key, the private key. The public key is, consider it that your email address. That's how you move coins from one person to another, and you give away your email address freely to everybody, no big deal. But the password to your email account is private, and you don't share that. That's what the private key is. So if you open an account at Coinbase, that account has a private key, but you don't have it. Coinbase has it on your behalf.
That's right.
And
yeah,
so,
Coinbase basically has customer funds pulled in a omnibus account of some sort. But when you even Coinbase though has a non-custodial wallet now in their offering. So as a Coinbase user, you can actually move funds from your exchange account, which is the default account that you get when you sign up on Coinbase, and you can create a Coinbase wallet where you are actually in control of your private key, and then you can tap into DeFi through that wallet, and then get access to these protocols.
And so what do you mean by the phrase, not your keys, not your coins? You're essentially saying that if Coinbase is handling the account for you and they have possession of your private key, at the end of the day, possession is 9/10, the owner, right? So that argues that technically bad things could happen.
Bad things could happen. FTX could happen, basically.
So the real key here is self-custody. You want to own your coins directly. You want to do this in a personal wallet, a digital wallet that you maintain. And you have the keys to that wallet. Nobody else does. You're providing the safeguarding. So
that's right.
Is self-custody therefore the future of crypto? Is that in the end what everybody will ultimately be turning to? They may use Coinbase for the purposes of buying and selling their coins, but they're not going to use Coinbase for the storage of their coins. Is that what you're saying?
That's what I'm saying. I think self-custody is just going to get easier and easier. And I mean, all it takes is for a big hardware manufacturer like Apple to ship a hardware wallet in your phone, and then suddenly everybody is self-custody. So today, self-custody is a little bit more challenging than just opening an exchange account like Coinbase or Gemini or Kraken. I believe that it is worth doing, even if it's somewhat complicated at first. But I mean, 2, 3, 4, 5 years from now, it'll just be the norm. And we'll look back and say, oh, look at the past and how hard it was to get your own wallet. Now we carry one in our pocket.
And you mentioned Apple. Talk about what Apple and Google, Microsoft, Samsung, all the big major tech companies, what are they doing in this space? Anything at all?
Well, I mean, Apple was recently in the news for basically somebody found a hidden copy of the Bitcoin white paper on every modern copy of Mac OS. So, I mean, nobody knows if this was a crypto enthusiast at Apple who did this, who snuck in the Bitcoin white paper into the OS, or if this is Apple's little way of saying we're watching closely what's happening in crypto. But we've seen tangible examples of big players getting into the space. Microsoft announced that they're adding a crypto wallet to their Microsoft Edge browser. So if you're a Microsoft, a Windows user rather, and you use their browser Edge, you're gonna basically have a wallet in your browser right out of the gate. No need to download additional plugins. Samsung has had a mobile wallet for a while. They've been testing the waters of crypto for some time. I think every major company in tech is looking very closely at this if they haven't already dove in. Then you have major consumer brands and huge companies like Starbucks actually doing a lot of things within NFTs and kind of experimenting with rewards. And I mean, I think there's a lot happening in that doesn't make the news. Some of it does make the news. I think there's a lot of experimentation going on. And as with everything, there are cycles in technology. I think this is a builder's market where now heads down, people and companies are focused on building the next use cases. And hopefully we're going to see those come out very soon.
All right, so talk about wallets in the context of self-custody, because it's all about the wallet. First of all, just define what a wallet is. I think a lot of advisors are confused on the fundamentals of this. What's a wallet?
Yeah, so I think the biggest confusion when I think the word wallet was probably poorly chosen, because a crypto wallet doesn't actually hold your tokens. A wallet it really holds your credentials. It holds your keys. So I would basically explain a crypto wallet in the example we used earlier, where you have a public key, which in the traditional world it could be your email, and you have a private key, which traditionally it could be thought of as your password. The difference is you don't choose them; they're generated with math and cryptography. You basically have a public key and a private key. The private key is in the wallet, and it should not be exposed unless you actually request it to the software or the hardware that you're using. You never actually expose it to anyone, because if you get a hold of somebody's private key, you basically effectively get a hold of their assets. With those private keys, however, you can actually sign transactions and authenticate yourself on this public ledger that is the blockchain. So every transaction that you make on whichever network you're using, if you're transacting on the Bitcoin blockchain or Ethereum, every transaction is going to be linked to your public key. So that's how people know that that transaction was made by this user that holds this public key. And then in order to actually make that transaction happen, you need to sign from your wallet with your private key. So there's a number of different types of wallets. There are hardware wallets, there are software wallets, there are hot wallets, warm, cold wallets. The type of wallet that you should be using depends on a number of different factors. That's where actually working with an advisor, if you're new to crypto, comes in handy. If you are technical and you've been in this space for some time, chances are you've already got your setup in place. I would say there are plenty of good options on both software and hardware wallets. I mean, on the software side of things, for a wallet that is connected to the internet at all times, which is called a hot wallet, there are options like MetaMask and Coinbase Wallet. They will allow you to interact with any DeFi protocol and use and allocate your assets that are tied to your private key in that wallet directly at any time. If you're looking for a little bit more security and you don't want your private key to be online all the time, then you probably should look at a hardware wallet. There are options like Trezor and Ledger. out there that will make this easy for you. And then as you kind of dive deeper, and especially as your assets grow in value, you're going to want to invest in maybe a little bit more security and diversifying your risk, because there's risk with everything, and that's where things like multi-sig come in handy. So a wallet like Gnosis might be a good idea if you want to have multiple people have to sign or approve a transaction, not just yourself, but more than one person. That's where an option like Gnosis comes in handy.
So I want to make sure that we're clear on the terminology. That was a really good explanation. A hardware wallet and a hot wallet, true or false, are the same thing.
A hardware wallet is usually a cold. So a hardware wallet it'll be a device that is not connected to the internet.
So I'll say it again.
Mhm.
That's why I'm glad we're getting clarification. The hardware wallet is a physical device. Think of it as a thumb drive. It's a physical device that you hold. And because it's a physical device, it's not connected to the internet until you plug it into your computer. It's not connected to the internet, and therefore it's a cold wallet. Cold meaning disconnected. So a hardware wallet and a cold wallet are the same thing.
That's right.
And a software wallet is by definition, a software wallet. The software is connected to the internet, and therefore it's a hot wallet. So software and hot are the same thing.
A software wallet could be cold. It could be in a computer that is never connected to the internet, right?
Okay.
So I mean, what makes it hot or cold or warm is whether it's ever connected to the internet or not. So it could be warm, which means that it sometimes is, it sometimes isn't. Cold, it means that it's never connected to the internet. And hot, it means that it's always connected to the internet.
And so the real key here to understand is whether you have the ability for a hacker to gain access to your laptop and therefore gain access to your private key. If your private key is residing on your laptop and your laptop's connected to the internet, you have the risk of getting hacked. That's the whole point of a cold wallet, of a hardware wallet. Get it off the internet, get it off your computer. And this way, unless someone physically steals your wallet, you've increased the level of safety.
That's exactly right. And wallets will have an additional password that you need to enter in order to actually be able to use it. So there is a level of protection. Even if your physical device gets stolen, they'd have to guess their PIN. And most wallets, I believe, will wipe their data if you enter the password multiple times wrong. So there is an additional layer of protection there.
And so what we need to recognize is, I think most clients, most people who own Bitcoin probably are not aware of all of the different options for custody, whether it's hot or cold, hardware, software. And since they don't know their options, they're probably doing it the default methodology, via Coinbase or some other online exchange. And that default option may be the riskiest. It may be the least secure, simply because they're not aware of the alternative methodologies that are available. So that's the first thing advisors need to do, is become familiar with these different types of wallets, not just the terminology you and I have described, but the companies that you've mentioned, Ledger and Tether and others that make these hardware wallets, so that by your being familiar with them, you can assist your client when you discover that your client owns crypto. In your next client review meeting, hey, you own real estate? Do you own insurance? Do you have money in cash reserves? Do you own crypto? And just in the nature of casual conversation, when the client says, yeah, by the way, I bought some Bitcoin. Great. Where are you storing it? That introduces the conversation of custody to help the client understand if they're handling their custody the right way. So now
Exactly.
what I want you to do for us, Miguel, is provide the linkage between the client and their crypto holdings and the advisor. Because if the client does own crypto and they're doing it on their own, that's money the advisor's not managing. That's AUM we're not billing the client on. It's an asset that we're not rebalancing as part of the rest of the portfolio. We're not helping the client with tax record keeping and tax reporting. We're not doing our job the way we're doing it with all the other asset classes. So how do we link the client's independent activities of crypto with the advisor's efforts to manage the practice? Talk about putting those two together.
Yeah, I think that's $1 million question in this market, specifically because advisors report. I think it's something like 60% of advisors report. This was a Bitwise survey that was done earlier this year. 60% of advisors report having most, if not all, of their clients investing in crypto on their own. So this is AUM that is left on the table that they're not certainly not advising on, certainly not taking their fee on. And it does a disservice to their clients, because if you're managing somebody's entire financial picture and you're missing a growing, in fact, it's one of the fastest growing, if not the fastest growing asset class out there, you're missing a very important piece of their net worth. So yeah, you definitely want to include that in your financial planning and your overall client's financial picture. So self-custody, I think on the security side, on basically keeping more of your assets for you and not for a middleman. There's an additional element, which is the ability to track everything that is happening with those assets, which you can't do with an exchange. You don't know, again, with a centralized player, you don't know what's going on. It's really hard to audit. But if your client is self-custodied, you basically get to see everything that they do, every transaction, every balance and change in their positions. You can track that in real time. So that actually makes your life easier. I mean, financial advisors are in the business of compliance as well. It's important that you can go back and reference, here's what happened every step of the way, right? And so basically connecting clients and advisors together and helping advisors make recommendations on their clients' self-custodied assets. That's what we're focused on. And I think one step in addition to that, basically providing access to these decentralized financial products and services so that clients don't have to worry about the technicalities of, for example, having to rebalance. You mentioned taxes, financial planning, estate planning. If an advisor can keep an eye out for a client's portfolio and they can make actionable and timely recommendations, then as a self-custodied individual, all I need to do is get my recommendation from my advisor, and I ultimately have the discretion of accepting that transaction. So it kind of streamlines the whole process of managing your assets, making sure that you're executing on your risk management, on your tax planning, on your financial strategy that you've set out to do. And whether you're technical or not, whether you're sophisticated or not, I think there's value in having somebody basically keeping an eye out for you and your assets, and then checking in when you need to take action on a specific transaction.
So let me ask you this, Miguel. Custody is a huge thing for advisors. There aren't terribly many golden rules in our business, but one of them is thou shalt not custody, because advisors know that as soon as you custody, you have a huge array of rules you've got to follow, and liability issues, and it's a huge deal. This is why we use outside custodians. This is why advisors use Fidelity and Schwab and TD Ameritrade and others to handle the custody services on their behalf. And the advisors merely strike an agreement with their client that says, we will be able to have view rights of your account. We can often have trading rights. We can buy and sell securities on your behalf, but we don't have custody. We don't have the ability to liquidate. We don't have the ability to transfer money. All we can do is monitor, handle record keeping, and do trading. Are you suggesting that through L1, advisors can accomplish the same goal with crypto, that they aren't taking the custody role, but they can have insight into that client's self-custody crypto account so that the advisor can do their job for their clients' crypto the way they do their job for the clients' ETFs and mutual funds.
That's exactly what I'm saying, Rick. So our platform basically enables advisors to, in a completely non-custodial and non-discretionary way, be able to know and keep track of their clients' self-custodied crypto assets in real time, track their positions, track their balances, track everything that their clients are doing on their own. And then on top of that, make recommendations directly on the protocols that their clients want to transact on, whether it's swaps for swapping different tokens, or providing liquidity on different automated market makers if their clients want to generate yield, or getting loans and managing their positions for any collateralized loan that their clients might have. An advisor can see what's going on and then make recommendations that ultimately are accepted or rejected by their clients. And there's a lot going on in the world of custody today. It's around crypto, and a lot of uncertainty. The SEC has proposed a new crypto custody rule that is actually going to make it very hard for advisors to comply. And certainly there are qualified custodians out there that advisors may be able to use to address those needs. But the SEC made it very clear that even if you have discretion, not custody, but discretion, if you have the ability to just make a trade on behalf of a client, that will be considered custody. And so it really changes the game. It'll make it really hard for advisors to comply, which is why everybody's looking at self-custody. And then people that have self-custody, clients that went into self-custody are not coming back. If you have a client that is investing in crypto on their own, they are never sending their assets to a qualified custodian, or otherwise. They're going to want to be self-custody. So that's where we come in as well.
So it strikes me as a pretty fundamental service that you're offering to provide advisors, and worthy of people to look into. We got a lot of great questions here, so let's try to tackle as many of these as we can from the audience. One that is as fundamental as it gets. We've talked about the idea of self-custody. Somebody uses a hardware or a software wallet. They get their own private keys, and then they lose it. What happens if you lose your password?
I mean, there's no way to sugarcoat it. If you lose your private key, you lose your funds. So that's one of the downsides of self-custody today. There are increasingly a number of services being built around private key management and recovery. There's new technology being built that basically don't require you to actually manage your private key. Your private key lives encrypted on a device or on the cloud, and it's usually split in different shards. There's technology that is actually going to solve this problem. I believe that ultimately the way that you solve this problem is by basically actually I don't have the answer to that. No, I don't think there are a lot of people who have the answer to that. I think hardware manufacturers are gonna make that less of a problem over time. We are betting on self-custody getting easier. That involves private key management. But yeah, it is a problem.
I'll give you two answers from my perspective. Number one, you can't fix stupid. I mean, this is your private key. This private key represents your investment in crypto, which may be hundreds of thousands or even millions of dollars.
Yeah,
you better protect it. I mean, there's simple as that. You need to protect it. Now, this doesn't simply mean writing down the private key on a piece of paper and sticking it in a safe, secret location in your house. No, that's not what I'm talking about. You need to take additional steps. And there are some companies that manufacture, like Bill Hodl, that manufactures a titanium repository where you write down, but you're using titanium chips, each representing a letter of the alphabet, to write down your passcode. The theory being that being this very durable metal, it is resistant to water damage, fire damage, heat damage, cold damage, etc., so that it's far more likely to survive an event than a piece of paper is going to be. But you still need to put that thing in a secure vault somewhere, either in your house or at a bank safe deposit box. Some, if you talk to the Winklevoss twins in their book, where they describe their history of their journey into crypto, they describe how they take their private keys, split them into 4 sections so that there's no one place that has the key. Each place has 1/4 of the key. And then they secure each of those 4 pieces in 4 different banks' safe deposit boxes around the country. That might be a little excessive, but
well, maybe not when you're the Winklevoss.
Yeah, maybe when you're not, when you're dealing with billions of dollars worth of crypto, maybe it isn't so crazy. But that's the point. You need to be careful. It's as simple as that. And we hear stories in the media periodically of people who have lost their keys, or they have forgotten the password to access their hard wallet. You can't fix stupid. It's as simple as that.
Yeah, you got to treat it like your money. So you got to be careful.
Ledger has been in the news lately, and we have a couple of questions from the audience about Ledger. Ledger is one of those hardware wallet companies. They may be the biggest, one of the oldest for sure, that is highly regarded. They recently made an announcement that they're going to provide, to the point you made earlier, Miguel, they have offered to provide an online solution for password recovery, for your private key recovery. If you somehow lose your private key, they have created a method for solving that problem. The crypto community has reacted very negatively to this, partly because Ledger admitted that since they have the ability to recover your private key, in essence means they have access to your private key. And they admitted that if they were subpoenaed by a government agency, they could be compelled to turn that information over to the government, meaning the government gets your private key, and therefore the government theoretically could get your crypto. The crypto community is enraged by Ledger's announcement. And in fact, Ledger walked it back yesterday and said, we're changing our mind. We're not going to do it. Never mind, etc. The question we have from a couple of folks, talk about your thoughts about Ledger's recent news and what you think this means.
Yeah, this is a loaded topic. I think we could spend an hour talking about this. My main thoughts on this is an example of a terribly poorly executed launch of a new product. I think the community has all the rights to be enraged. I'm not a Ledger user. If I was, I think I would also be pretty enraged. I think the way they executed the announcement and the launch of a new product was really poorly done. I think it's important to make it clear that Ledger cannot just simply push a new firmware on your device and suddenly get a hold of your private key and basically get you enrolled into this program without your consent. This is a new product called Ledger Recover, and I'm not trying to defend them or anything, but I think if people that have a Ledger device are listening, I think it's important to explain that this is a new product that you have to opt in, and to opt in, you have to download the firmware. I don't know if there's an additional step to have to opt in afterwards. If I could change something, I would have probably just built a new product separate from the Ledger hardware wallet that people hold, and I would have launched this under a completely new device that, in order to actually opt in, you have to buy the device, which comes loaded with a new firmware, and it's separate from your existing Ledger device, and therefore you don't even need to worry about downloading new firmware. I think it was poorly executed. I think if I had to guess, they might actually decide to launch it under a new device. I hope they do. That would be best, I think. But yeah, just poor execution and announcement.
Yeah, and it was a surprising stumble. I think they got ahead of themselves, because the issue of people fearing they lose their private key, that's a big fear. It's a common common reason people are reluctant to use self-custody. And so they said, well, we'll solve that problem for you without thinking of the implications of their solution. So I think you're right. I think they'll come up with an alternative. But I also think that this doesn't necessarily have to undermine your confidence in their credibility as a hardware provider for crypto custody. But it does demonstrate how this is still an evolving environment. So I'm just looking at some of the other questions that we've got. One asks, can't you simply make duplicates of your private key for safeguarding?
Yes, and that's actually something I do personally. You can always buy a second device, a second hardware wallet, and just restore the seed phrase, a backup phrase of the first device that you're using as your main device, and you could put that on a security box and just forget about it. And if your main hardware wallet ever gets stolen or it physically damaged, you always have access to an additional, a different device that has your private key already. So yeah, definitely something you can do.
So yeah, I think that makes sense. Redundancy is always a good idea.
Definitely.
So I think that certainly does make a lot of sense. Peter, one of our listeners, is asking, talk about, Miguel, how does one go about getting involved with your company? What's your fee? Talk about the logistics of becoming a client of L1.
Yeah, so L1 is live in the market. So if you're interested in becoming an advisor and adopting L1 on your practice, just go to l1advisors.com. There's an option at the top that says I'm an advisor. Once you do that, there's a quick 2-minute form that you have to fill out, and then you can create your account. So it's a fully self-serve product. You can get started at any time. We do not have any upfront fees. Our fee is very simple. We charge 50 basis points off of the assets under advisement that you have on our platform. So if you don't have any clients right now who you want to work with through L1 Advisors, you're not going to pay us any fees. The moment you start adding assets under advisement, which means that you have clients in self-custody whose assets you are advising on through our product, then you're gonna start accruing platform fees. And at that point, it means that you are most likely also charging your fee to your client. So very simple to get started. We make it also very easy to onboard your clients onto L1. That's actually one of the greatest benefits of crypto and self-custody. And this is why crypto as the infrastructure is so much better than what's available traditionally. Your clients can simply grab their hardware wallet or their software wallet, and then they can click a button. And then with that, you get read-only access to their assets, and you can start working immediately and advise on those assets. Try doing that with a traditional custodian, where you have to sign a bunch of paperwork and wait for if they have to make a deposit or initial contribution, wait for that to clear. I mean, you can literally just get started and start working with the client in minutes. And so we streamline that through our platform. And then we also do one-on-one onboarding calls. So somebody from our team will reach out. Most likely it'll be me to schedule an introduction, and we can dive in deeper into our product and help you kind of incorporate it into your practice and tell you more about what you need to know.
So explain a little further about the fee. If you're charging 50 basis points, how is that fee being collected? Are you debiting the advisor, or are you billing the client?
So we do not have access to any funds ever. So we cannot simply debit funds from either the advisor or the client. What we do is we take a daily snapshot of your client's assets and their value, and we'll do a weighted average on a monthly basis of the asset value of your clients. And then on top of that, we'll apply our fee as a platform fee, so the 50 basis points, which are, by the way, comes down as you get more assets under advisement. So we'll apply our fee, which is charged to the advisor, and then we'll apply your fee, which you set your own fee through your settings. So we'll apply your fee, and we'll generate an invoice that gets sent to your client. From there, we make it easy for you to request payment from your client through L1 if you want. So you can request a payment in USDC from their wallet, or you may already have a direct debit or a way for you to get to charge your client traditionally. Say you already have a brokerage account or some traditional account that you charge your clients for your traditional assets. You may want to just charge them that way, and then you all you need to do is mark your fees on L1 as paid, and then you have the option of waiving fees if you'd like as well.
Got it. Kudry is asked, curious to hear your views, Miguel, on whether crypto has more viability being viewed as a technology over the next 10 years versus a currency.
So I think we're I mean there's all sorts of I think crypto is a technology, period. Crypto as a technology can power different currencies. I mean, look at the amount of US dollars stable coins that are transacted on chain. So they're USD as a currency, but it is more efficiently exchanged and traded, and I would argue even stored on chain, which is powered by crypto. And so I don't think crypto and currency are mutually exclusive. I think some cryptocurrencies can be used as currency, and I think most currencies, most assets, I would argue all assets, could run on crypto and become tokenized and be traded and stored and exchanged on chain. So yeah, I think that's how I would approach that. I'm not sure if that answers the question though.
Yeah, I think it does. You mentioned earlier that for most folks, when they're just getting started in this, they'll use a CeFi platform. They'll open an account at Coinbase, for example. But at some point, as they learn more, get more comfortable, familiar, they'll move from CeFi to DeFi. The question here is, at what point would you suggest making that jump from CeFi to DeFi? Is it a certain dollar amount? Is it a certain percentage of assets? At what point?
I think that answer is different for everyone listening. I think there's certainly a point where you would care to lose a certain amount of money. That number is different for all of us. I think that's probably the no-brainer time to move those assets off a CeFi platform. Even before that, though, if you want to dive into DeFi, you're going to have to move your assets off of an exchange, and you're going to have to move into a self-custodied wallet, which could be Coinbase wallet, so that they make it very easy to transition. It could be your own hardware wallet. It could be MetaMask, whatever your choice is. If you want to use DeFi protocols, you're simply not going to be able to do it on a CeFi platform. So that's regardless of the amount of money that you have. That would be, in my case, a big enough reason to go into self-custody.
Yeah, I would argue the same. I don't think it's a real dollar amount issue. I think it's a safety and a control issue.
Exactly.
So I would argue that, buying your coins initially on a CeFi platform like Coinbase or Gemini, perfectly fine, but don't store them there. Transfer them to a cold wallet. I think that, for me, that's the answer that I use. One final question. We have so many here, but just running out of time. Ken has asked about, do you provide at L1 any level of education to advisors or to investors regarding the whole custody conversation?
We have engaged in person and online education. We are actually in the process of producing some educational materials that can be shared with our customers. We're also working with partners to bring in onboarding education and also analysis on tokens and assets from third parties. So yeah, that's something we are actively doing. There's even a feature on L1 Advisors called the Risk Score that actually educates both advisors and clients on their level of risk exposure that they're taking, and that's an educational tool that we have. We want to do more and add more information as to why your risk score is what it is. We do some high level breakdowns. But yeah, education is definitely something that we want to be a catalyst of. both being a direct producer of it and also an enabler. I think our own advisors, people that are using our product, are actually creating educational materials themselves. I would expect them to share some of it publicly. Some of them have already done that. But I think the community, that will be the most powerful content that's created. The community of financial advisors that dive into crypto will produce that content ultimately.
We've had a really wonderful conversation here. We've been talking with Miguel Kudry, the CEO and co-founder of L1. If people want to reach you, Miguel, the web address is
L1advisors.com. And we are also on Twitter. It's the same name, at L1 Advisors.
It's been, I think you're going to get a lot of conversation from folks. This whole issue of custody demonstrates for you how much you need to learn about the subject of crypto, and why I encourage you to obtain your certificate in blockchain and digital assets. It's an online self-study, self-paced course, world-class faculty. Scott Stornetta, the co-inventor of blockchain technology, is on our faculty. Anders Bronworth of the Boston Fed and others. You get up to 18 CE credits. Half the course is on the tech, the other half is all on practice management. And there are 4 separate tracks, one specifically for financial advisors, and you can get both basic and advanced certificates. And if you'd like to spend time with Miguel, he's going to be at DACFP Vision. He'll be speaking there. The event is going to be June 13, 14. This is the longest running digital assets conference specifically for financial advisors. It's an awful lot of fun. Among other things, we're going to teach you how to mint your own NFTs. So if you haven't yet registered, I encourage you to do so. Downtown Josh Brown will be keynoting. Patrick McHenry, the chair of the House Financial Services Committee, who's preparing legislation for crypto. And on the other side of the aisle, the flip side of that coin, Dave Hirsch, the head of crypto enforcement for the SEC, keynoting as well. So I encourage you to go visit us at DACFPvision.com and join us in Texas for that. And be sure to read my #1 Amazon bestseller, The Truth About Crypto, which will tell you everything you need to know about this subject. And listen to my daily podcast, available everywhere you download your podcast, The Truth About Your Future. It's in the top 1% of all podcasts, according to Apple, who says there are now 5 million podcasts in the United States, and mine is in the top 1%. So thanks very much for joining us on the program today. Miguel, thank you for this terrific information, and I'll see you in Austin.
I'll see you in Austin, and thank you everyone for tuning in.
Thanks for joining us. Have a great day.